Welcome everyone. The name of the presentation today is How to Escape the Retirement Tax Trap. In this hour-long event, you're going to learn about the biggest dangers you'll be facing during your retirement years and how you can avoid them. You're also going to learn about one of the most ingenious creations in the history of financial products, and at the conclusion of this presentation, you're going to be one of the very few that understands it. So I'm about to show you an incredibly powerful financial strategy, and it's one that your financial advisor has probably never told you about, and I'm going to tell you why that is. I'm also going to show you how you can have a tax-free retirement income rather than a tax-deferred income and why that's important. I'm also going to show you how you can participate in the stock market and enjoy its gains without any risk of loss whatsoever. I'm also going to show you how you can access your money at any time and without penalty. And we're also going to cover how this strategy outperforms most 401k plans. I will also show you how your money earns a favorable and predictable rate of return. I'm going to show you how you can never outlive your money. And I'm going to show you how your money can transfer to your beneficiaries or favorite charity, all completely free of taxes. And ultimately, my hope is that by the conclusion of what you're about to learn here today is that it will result in a positive life-changing event for you as it has for me, my family, our current clients, their families, and their future generations. So you'll definitely want to have a pen and paper handy to take notes, and as you have questions that arise along the way, enter them in the chat box and I'll answer them at the end of the main presentation. So get comfortable, grab your favorite beverage, and get ready to learn about one of the most amazing financial strategies that exists today. But before we really get started, we have to get the compliance out of the way. So if you can take just a minute and look over this screen, basically this presentation is for educational purposes only, and it's to provide you with general information not relating to anyone's personal circumstances. I'm going to leave this up for a minute so you can read it and get situated. Okay, hopefully everybody had enough time to review this, so let's go ahead and jump into this. My name is Michael Nash, and I'm the co-founder and CEO of Clear Diamond Life. I began implementing these strategies we're about to discuss in 2006. I have over 20 years of experience in financial services, and I'm passionate about helping my clients acquire wealth while minimizing taxes. In addition, I have surrounded myself with a team of wealth strategists that share the same passion to help you avoid the retirement tax trap. Being a numbers guy, my role here at Clear Diamond Life is teaching the seminars and meeting with our clients one-on-one. Since we have clients all over the country, most of our meetings are actually done by phone and over the internet. Also moderating today's training is Jeff Butler. Jeff is the co-founder and president of Clear Diamond Life, and he's also our expert in college planning. Even though today's training is focused on escaping the retirement tax trap and how to build tax-free wealth, this strategy is also an excellent tool for college planning. So Jeff will be monitoring the chat for questions that you may have along the way. So when you do have a question, simply enter it in the chat box, and we're going to cover as many of them as time allows in our Q&A session at the end of the presentation. Now, as a bonus for staying until the end of the presentation, you will receive a replay of this training within 24 hours of the conclusion of the event by simply completing a short survey when this webinar has ended. Now, I know there's a lot of information to consume and digest, so having the replay link will allow you to go back and study the areas where you need more time. But I want to warn you, the replay link will expire in 14 days, so be sure to watch the replay immediately. Also, for those that stay until the end, you will have an opportunity to receive lifetime free access to 13 instructional videos that go into great detail about the concepts we're about to uncover. The one thing I really hate about web-based seminars and trainings is how much time the presenters spend talking about themselves. So I'm not going to do that in an effort to save time, since we are going to attempt to keep the main presentation to an hour. However, if you have questions along the way, which I'm sure you will, again, please post them in that chat area, and I'm going to remain online after the presentation to answer them. Now, typically when I teach the seminar, I do it in a dinner setting in a live event, and I have at least 2 hours to get the information across. So I am going to go fast with this information, but remember, when you get the replay link, if you stay to the end of the presentation, you'll be able to pause the video on the replay along the way so you can catch up and take more notes. Here's what we want to accomplish over the next hour. We're going to go over 5 things during this presentation. First, we're going to examine who the wealthy are, and frankly, I think this one will really surprise you. Next will be the 3 biggest risks you'll be facing during retirement. Then we will cover the number one tax minimization retirement vehicle. We'll examine a real-life case scenario, and finally, what your next move could and should be. So let's dive right into things by first taking a look at exactly who the wealthy are. And this one may surprise you, but it does lay the foundation for what we're about to discuss. What I'd like to do right now is to play a game that will allow us to identify what the difference is between a common amount of income that a person makes and an uncommon amount of income. So what I typically do at this point during my in-person events is that I ask the audience these questions. So if you look at the amount of money that the average married couple makes in the United States, that is filing their taxes jointly, if we had to define what you would need to make to be in the top 25% of the wage earners in the United States, how much money do you think that married couple would need to make? Now, during one of our dinner seminars, a typical answer we receive is about $100,000. So let's put that right here. So to be in the top 10% of wage earners, how much money do you think they would need to make? Again, a typical answer is about $250,000. And then the top 5%, we get a common answer of about $500,000. And then you can probably guess that to be considered to be in the top 1% of American wage earners, people usually say about $1 million. Now, like I said, I've asked these questions to people in our seminars across the country, and these are the common answers that I get. What I want to do now is to show you what the actual true numbers are, the real statistics of what it takes to be in the top 25% of wage earners, and as I stated earlier, I think the results are not only going to surprise you, they may actually shock you when you compare these to the real numbers and your income. So to be in the top 25% of wage earners in the United States, you only need to make just under $69,000 per year. And like I said, this number usually shocks people when you consider that to be in the top 25% that you only need to make $69,000 per year. Now, while we realize that $69,000 per year is affected by your geographic location and the cost of living in your area, the end result remains the same as far as taxes are considered. So to be in the top 10%, that's going to be $116,000 per year. Pretty shocking, isn't it? Now, to be in the top 5%, it will actually only be $169,000 per year. And finally, to be in the top 1%, that's the elite of American wage earners, the super wealthy, the ultra rich, you only need to make $368,000. The point I'm trying to make with this illustration is that is the amount of money that you make uncommon or is it common? I would venture to guess that if you're engaged in this training, the amount of money that you make is somewhere north of $69,000 per year. And if that is the case, again, you are in the top 25% of wage earners in the United States. So, by definition, if you fit in this category, you have an uncommon amount of income. This means everyone else falls into the bottom 75% of the population, or what we will call our common wage earners. So when you go to look for financial advice or go to look for places to put your money, do you look for common advice or do you look for uncommon advice? When we go to the internet or we want to read a book or we watch any of the financial entertainers, the message they are typically delivering is geared towards their biggest audience, which is the bottom 75%. That's where the numbers are for their book sales, their TV and radio show ratings, and the advice that can be found here is typically common advice, which is things like pay your mortgage and your car off as fast as you can, make extra principal payments, max out your 401k, invest in mutual funds, buy this pharmaceutical stock, and so on and so on and so on. So again, who are they trying to target? Is it you in the top 25%? No, not at all. Most of this advice doesn't apply to you. Even though it's sound advice, but it probably doesn't apply to you since you've already established yourselves and are well into financial maturity. So since this type of advice is again typically more applicable to the lower 75%, we need to search elsewhere for uncommon advice and strategies the wealthy have been using for decades. Okay, so still looking at who the wealthy are, now we're going to dig a little bit deeper and explore the three types of ways the wealthy, and most likely you that are watching this web seminar, can build wealth. To make things a little easier, I've laid out three buckets on this slide. These buckets, if you will, are the three types of ways or methods to build money. There's taxable, there's tax deferred, and finally there's tax-free. So first, let's go over the taxable accounts. What kind of accounts do you think go inside the taxable bucket? We can have cash, can have a checking account, we can have a savings account, CDs, stocks, and there's some others, but these are the most common ones you'll hear about. The benefits of this bucket is that your money is liquid, so you always have access to it at any point. Remember the term liquidity because we want to circle back to that one later. Now, what would you say about the tax-deferred bucket? What kind of accounts would you find in there? Qualified plans are our most common things we find in this bucket, things like 401ks, IRAs, 403bs, and savings bonds. Tax-deferred is a great option because you're deferring those taxes so your money can grow faster through compound interest. But my staff and I usually call this bucket a tax postponement because you're simply postponing the taxes you're going to pay. Now the question really becomes, and it's a very important one, do you think the tax rates in the future will be higher than what they are now? Do you think they'll be the same, or do you think they'll be lower? We're going to discuss this more in depth in just a little while. And then finally we have our last bucket, our tax-free bucket. This bucket is just that. These are accounts that are completely tax-free. What kind of accounts do you think fall into this category? Most people say municipal bonds, but those bonds count as provisional income because they can increase taxation to Social Security. So technically, it's not a tax-free account. Now, there are 529 plans, but they must be used for college expenses, and then there's a limit to how much you can put into that type of account. So this account comes with an asterisk. Then you have your Roth IRA, which is a great account. However, there are limits to how much you can put into it on an annual basis. And if your income exceeds $131,000 filing single, you can't even contribute to a Roth. So just think about that for a second. Most people with a tax problem cannot use this tax-free account. The goal here is to make sure your portfolio is diversified in all three buckets, but with an emphasis on having as much as you can in that last one, the tax-free bucket. Now, are there other accounts that are available for the tax-free bucket? Absolutely, and that's what we're going to discuss in just a little bit, as I'm sure that answer is really going to surprise you. So let me assure you, there is hope, but before we get there, let's first consider the risks that face us. As you're nearing retirement, there are three risks that you need to take into consideration when planning. We have stock market volatility, we have longevity, and we have tax rates. These are the three biggest risks that you'll be facing as you head into retirement. So first, let's take a look at the stock market risk. This graph shows us how the stock market has performed since 1900. Overall, you can see the stock market has done really well over the long run. However, if you break it up into 5 to 10 year segments, you can see that there's some serious volatility if you'll notice all the ups and downs. Another good illustration to show is the breakdown of the stock market of when there is a bull market, that's when stocks do really well, and when there is a bear market, that's when stocks decrease in value. This is a graph showing the bear and bull markets all the way from 1926 up until now. As you can see, there have been some really large gains over the years. However, there's also been a substantial amount of losses. And there are two takeaways from this graph. One is, if you are retired today, being in a bull market or being in a bear market can mean two very different things to your retirement income. Just imagine if we were sitting in a bull market right now and you're retiring in 5 years. By looking at the graph, history has shown us that a bear market, which is again a loss to the stock market, is right around the corner. That could have a significant impact on how much money you will have when you need it the most. And the second takeaway is that you need to focus on how to protect yourself during the bear market times. So the first step in dealing with volatility is being able to smooth out those peaks and valleys so you don't experience those large losses. So as we dive a little bit deeper, you're going to learn exactly how we do that for our clients. What we want to do now is to take a look at the buying behavior of the general consumer. What you would like to do in a perfect world is to buy low, as you can see in the lower left part of the slide, and eventually sell high. Over a given time period, the market has averaged about 9%. That's a great average if you were to buy low and sell high. However, most people in the stock market do exactly the opposite, and it ends up looking like this red line. They wait until a stock's doing very well, then they decide to invest in it. When they do this, they typically buy when the price is higher. Then they wait and they see that it's underperforming and going down. Then they make that emotional decision and sell it when the price is low. Then they see it going up again, so they decide to buy it again when the stock is higher in price. And then they sell it back when the price is low. And that cycle typically repeats itself over and over and over. Now, obviously, these are extremes, but you get the general idea I'm trying to convey. And by doing this, the average investor only earns about 3.49%. Compare that to the actual stock market performance of 9%, and you can see why people are not succeeding by putting all their retirement savings into the market. In fact, how many people can you think of that had a substantial savings set aside only to lose a significant amount of it to market volatility and timing? Oftentimes, when we need the money the most, we don't have the time to recover the losses we have incurred. Again, in just a few minutes, I'm going to show you how to avoid this from happening to you altogether by putting your market into our tax-free bucket. Again, bucket number 3. Now let's look at another example. Let's say you were to invest $100,000 in the stock market. The first year you lost 30%. How much do you think you need to earn the following year to get back to your original $100,000? Do you think that's 30%? That's the answer most people say, but it's more like 42%. If you lost 30% in the stock market next year, you would need to make approximately 42.8% to get back to your original investment. The reason why it's 42.8% is because you're earning interest on less money. In this example, you only had $70,000 in that second year to invest rather than the $100,000. So you need to earn 42% rather than 30% to get back to your original amount from a 30% loss. I hope you understand this concept, and if you don't, please let me know in the chat box and we'll cover it more in the question and answer session at the end of the presentation. Now here's another example about the volatility in the stock market. Let's say you were to invest that $100,000. Over this 15-year period, you can see we had some ups and downs. The first years were a loss, but it looks like we gained back some. Then we had a huge drop in 2008, which I'm sure everyone can remember. And lately, we've been working our way back up. Over this 15-year period, we see that we've only experienced about a 4% growth. Now, 4% is not terrible. It's definitely better than having a negative, but we haven't done yet is calculated all the expenses associated with this account. Things like management costs, which could be anywhere from 1 to 2%. Inflation is another thing to consider. The average has been about 2 to 3%. And of course, we have taxes. When you factor all this into that account, you end up with a number that's more like 0. Now that we have briefly discussed stock market volatility, let's take a look at longevity as a risk. Did you know that the number one fear most of my clients have isn't dying? It's true. Their biggest fear is that of outliving their money. So let's segue for a moment to look at one of my favorite examples. This is a picture of Mount Everest. Over 4,000 people have scaled Mount Everest, and about 250 people have died in this incredible endeavor. But did you know how most of those 250 people died? The majority didn't die attempting to climb Mount Everest, but they died getting down the mountain. You see, they planned and trained to get up the mountain, and they certainly made it, but a lot of them didn't think about how they'd be getting down the mountain. We can use this analogy for how people plan for retirement. They spent all these years planning and accumulating so they can get the most amount of money and get to the top, but when they finally make it and they're in retirement, most people don't have a plan on how to get down. This is where we help our clients not only accumulate the maximum amount of wealth, but we also help them distribute that in the most tax-efficient manner so they can make it to the bottom safely. The strategy I'm about to show you can be designed to where your money can last you into perpetuity and in the tax-free bucket. In fact, this strategy outlasts most other retirement plans, but certainly not limited to the very popular 401k, and I'll prove it to you. But before we get to that, let's continue looking at longevity for a moment. When you retire, we never know what's around the next corner for us, but our actuarial tables show us average lifespans, and it's important to know these numbers when planning for your distribution phase of retirement. Right now, these tables tell us the average lifespan is about 20 years past retirement. And in today's day and age, if you're 65, the average expectancy for females is 88 years old, while males is 85 years old. And if you're a couple, the average life expectancy increases. This is a graph demonstrating the probability of life expectancy. The blue line is for the males and the red line is for the females, and the green line is for couples. You can see that all the ages along the bottom, this goes from age 65 to 100, and the percentage of the probability is along the left side. There's a 50% probability that a couple will live until 90 years of age. That means that there's a huge probability that one of you, if married, will live beyond age 90. In fact, a better approach to making sure you don't outlive your income is looking at the 5% probability. There's a 5% probability that a couple will live until about age 100. When we work with our clients, all of our plans assume that you're going to live to age 100. There is not a bigger mistake in the world that a financial planner can make than to assume otherwise. Now, keeping with longevity for a moment, you must also factor in the effects of inflation. Typically, that's about 3% per year. The picture on the screen demonstrates the effects of inflation. Here in 2017, we can expect this car to cost about $50,000. Using a 3% inflation rate per year, you can expect that same car in 10 years will cost you $67,196. And in 20 years from now, that same car will be about $90,000. As we all know, everything is going to cost you a lot more in the future. Many people don't take inflation into account when planning their distribution phase, but it's something we include when working with our clients. As I previously mentioned, we never know what's around the next corner, especially as we get older. So another item to pay close attention to is the cost of long-term care. What are the odds that you'll need long-term care? Well, let's see. The odds of having a fire in your home is only about 3%. Yet you are required by law to have fire insurance. The odds of getting into a car accident is about 18%. And we all know that we're required to have car insurance. But the startling thing is that the odds of you needing long-term care is about 72%. Yep, 72%. Yet we are not required to have long-term care insurance. If you ask me, there's a major misalignment of needs here. So when we talk about the rising cost of long-term care and the effects of inflation, the average annual cost today of a nursing home care is about $84,000 per year. And in 10 years, it's projected to be $136,000 per year. Longevity with the inclusion of inflation and long-term care is a huge risk to consider during retirement and one that we do not overlook. So now that we've covered stock market volatility and longevity, let's go over taxes and tax rates. This is where things get really interesting. So what I want to do now is show you what is unique about people in the top 25%. And the most common thing about the top 25% and what makes them unique is the amount of taxes they will pay. The people that make the uncommon amount of income are the people that would be paying the majority of income taxes the federal government will be collecting. So I'm going to go over each one of these categories and I will show you how much tax each one of these groups accounts for. So this is the slide we went over just a few minutes ago when we were looking at who the wealthy were. The top 1% of wage earners represents 35% of the total amount of gross revenue collected by the federal government. When we look at the top 5%, it is 59% of the total collected revenue. The top 10%, that number goes to 75%. And finally, the top 25% of all wage earners combined equals 84% of all the taxes that the federal government collects every year. So would you agree that while you may not necessarily have a cash flow problem, I can almost certainly guarantee that you have a tax flow problem? And there's an even bigger one coming at you like a freight train down the tracks, and you're most likely completely unaware of it. So let's start with this. Again, the biggest and most important question we ask our clients that have qualified accounts, again tax deferred, is in the future, do you think tax rates will be lower? Do you think they'll stay the same as what they are today? Or do you think they'll be higher? Now hang on a minute before we answer the question because I want to show you this. I want you to take a look at this clock. This is a snapshot I took a few weeks ago of the national debt clock, or the U.S. debt clock, if you will. What you're seeing here is just a screenshot, but if you log into usdebtclock.org, you will see all these numbers moving in real time, and then believe me, they're moving fast. So fast that the number you see up here is now over $20 trillion. That number is the official debt that we owe as a nation. 20 trillion. That's 20 trillion with a T. And right next to that number is the debt per taxpayer. Keep in mind that number is weighted to the income that you make, so some people may actually owe the government $300, $400, or even $500,000. But to give you an idea of how much 1 trillion is, so everybody knows who LeBron James is, I hope. LeBron James makes $45.8 million per year. It would take LeBron James 21,843 years to make $1 trillion. The average life in the U.S. lasts about 2.4 billion seconds. 1 billion seconds ago, it was 1979. 1 trillion seconds ago, it was 29,700 BC. So when you think about how far in debt this country is, it is actually quite staggering. So now let's take a look at tax rates and their history. This is a chart that frankly scares the living daylights out of most of our clients when we think about where we are today and the numbers we just covered. The diagram you're looking at illustrates the top marginal tax rates from 1913 to 2015. As you can see here, the tax rates in 1913 were 7%. Then World War I happened, and the government had to offset the cost of the war, so they raised tax rates to an astonishing 77%. After the war concluded, tax rates steadily went down, and then look what happened during the Great Depression and World War II. Tax rates once again spiked. In 1944, 1945, tax rates were as high as a whopping 94%. That means if you were in the top marginal tax rate for every 100 additional dollars that you made, $94 of it would go to the government. Since then, you can see tax rates have been going down, and within the last few decades, you can see we've been hovering right around that 35 to 40% area. If you were to take the average tax rate over all these years, it comes to about 58.4%, and we are currently at 39.6%. So now that we're a little bit more informed, let's go back to that original question at hand, and let me ask it to you one more time. In the future, where do you think tax rates are going? Do you think they're going to be higher? Do you think they're going to stay the same? Or do you think they're going to be lower than what they are right now? With the recent financial bailouts and wars that we've had recently, the wealthy assume that tax rates have nowhere else to go but up, and they're preparing for that accordingly, and this is exactly what a firm specializes in. But let's assume just for a moment tax rates were to stay the same when you're in retirement. Now your three biggest tax deductions, mortgage interest, child exemptions, and qualified contributions, are likely to be taken away when you're in retirement. If you think about it, you've been hurrying to pay off the mortgage so you don't have that expense in retirement. The kids are likely all moved out of the house. Well, we hope they are. And you've likely stopped contributing to your 401ks and your IRAs since you're retired. Oftentimes, our clients find that they may even be in a higher tax bracket at retirement than they were during their working years for those very reasons. So let's take a look at why this person's 401k may not be working. Typically, when you look at the value, let's say $100,000 in this case, you think that that money is yours to use during retirement. What most people fail to look at and to remember is that this is tax-deferred money, and the Internal Revenue Service now wants its portion, which is at that 30% tax rate. In this case, that'll leave your original $100,000 with only $70,000 when taxes are taken out, and that's when it's all said and done. In fact, it's been said that the 401k is the single greatest retirement vehicle that the government has ever created for itself. Our goal, and what we specialize in, is to have a portion of your portfolio to be tax-free. And now that I've also painted such a dreary picture, I'm sure you're asking yourself, well, what choice do I have? Well, let's get into that million-dollar secret that we've been building up to, and I will disclose to you the perfect retirement vehicle. To really understand what financial vehicles the wealthy choose as their preferred choice, we need to first go over what everyone here would typically want in a retirement vehicle. I've listed out the benefits on the screen, and what we're going to do now is go one by one, and you tell me if this is something you would want in a retirement vehicle or not. I'm going to assume your answers for you, and this is in a perfect world, and what this perfect world could possibly be. Would you want to take risk in your account? No, of course not. So we're going to mark a no here, and we're going to put it in green because green is what you prefer. What about guarantees? Would you like to have guarantees in your account? Of course we would. So that's a yes with green. What about penalties? Would you want penalties? No, of course not. What about liquidity, use, and control? Yes, we would like to have access to it. Would you want your account to be protected? Of course we would. What about leverage, the ability to use your money to gain money? Yes, of course we'd like that. How about tax deferred? Yes, you would love to have the ability to compound interest. What about tax free? Of course, that's the ultimate goal. What about collateral? This kind of goes back to leverage, but the ability to use your money as collateral, yes, we would love that. Tax deductible payments, yes, we would love to have that. We would also love to have a disability benefit. And yes, we would finally love to have wealth transfers. So these are all the characteristics that you would be looking for in an ideal financial vehicle, again, in a perfect world. So we put all of them in green. Now, let's look at the common strategies people use to build wealth. Typically, it's qualified plans. These are your 401ks and IRAs, and as we dive deeper into these plans, remember, red is bad. Red means that that is not what you would want in a financial vehicle. If we take this section by section and look at the top, you would want no risk and guarantees, but 401ks and IRAs both have risks associated with them, and neither provide any guarantee. What about penalties and liquidity, use and control? You have penalties associated with these accounts, and liquidity is possible, but you suffer for taking advantage of it. That's why we're going to put it in yellow. 401ks and IRAs are not protected, and they don't offer you the ability to use them for any leverage. When we look at tax deferred, you have green here. This is probably the most popular reason why people choose to put their money in these accounts, because of its tax deferred benefit. But remember, it's more of a tax postponement than it is a deferment. And when you're postponing taxes, you're opting to choose to pay them at a later date. We all remember the slides that we just went over where taxes are more than likely to be higher in the future. So hold that thought as we search for the perfect financial vehicle, and trust me, it does exist, and we'll get to that in just a second. All right, continuing on, is it tax-free? Again, we are postponing taxes to some point in the future, and we're going to have to pay those at some time. So it's not tax-free. Can you use it for collateral? No, typically not. We finally have another green box, as you do have the ability for tax-deductible payment benefits. And obviously, there's not a disability benefit with a 401k. And finally, can it be transferred to your heirs in the most tax-efficient manner without interruption or significant loss? No, it cannot. So again, these are the most common accounts people choose to put their money in, but when you look and compare it to what you actually want in a financial vehicle, it's very different. And here are the rest of the most common vehicles: mutual funds, your home, CDs, bank savings, annuities, and real estate. There are some more yellows, but again, it's not an ideal situation. And for the sake of time, I'm not going to go into great length with each one, but if you have any questions about any of these, enter your questions in the chat box and we'll do our best to cover them after the main presentation. So getting back to what we were looking for in a financial vehicle, I've got some good news and I've got some bad news. Let's start with the bad news. The bad news is there's no financial vehicle out there that can offer all the benefits that you want ideally. However, what if we can offer this vehicle to you? Would you be interested? And before I show it to you, this is the point that I want you to have an open mind, just for a few minutes, as it will take me that long to come full circle. So suspend your disbelief, and if you'll trust me, I promise that you'll not be disappointed. And remember, something that is different isn't always better, but when something's better, it is always different. So with that said, hang on to your hats, because here we go. The financial vehicle that will give us almost 100% green on our board is cash value life insurance. Now, you promised me that you would allow me to come full circle here, so bear with me. Believe it or not, cash value life insurance has a product that is the number one tax minimization retirement vehicle when properly structured. It is also the strategy that Walt Disney himself used to fund the construction of Disneyland, which we will come back to in a few minutes. Now trust me, if it worked for Walt Disney, it can very likely work exactly the same way for you. So before we dive deeper into this $1 million secret, and it truly can be worth $1 million, if not more, let's back up just one step to explain the different types of insurance so there's no confusion going forward. The first type of life insurance everyone here has probably already heard of is term insurance. The typical approach for term insurance is that you buy the most amount of death benefit that you can. Let's say $500,000 in this case, and you want to buy it for the least amount of money, about $500 in this example. This is a great solution for that 75% demographic that I talked about earlier, because they have a cash flow problem and they need insurance, so they just buy the minimum. With term insurance, you also only receive one benefit, which is the death benefit. So do you want to know why term insurance is so inexpensive? It's because 98% of term policies never get paid out. Everyone purchasing a term policy is highly likely not to use it, and the insurance company knows this. You'll pay for a certain period of time or term and not use it. It's temporary. Term insurance is cheap, and it is a great solution for that 75% with a cash flow problem. So after term insurance, people start looking for life insurance vehicles that can last their whole lifetime. This is what we call permanent insurance or whole life insurance. Same methodology. You buy the most amount of death benefit that you can, again, let's say $500,000, for the least amount of costs. However, notice this time the costs are a bit more. In this example, they're $3,000. This is due to the policy lasting your whole lifetime, which means 100% of these policies get paid out as long as the premiums are paid. This is where some of the financial entertainers and radio personalities have coined the phrase buy term and invest the rest. It comes from because when permanent or cash value insurance contracts are not properly structured, they usually end up being one of the worst places you could ever put your money for anticipated growth. In fact, at Clear Diamond Life, we will never put you in one of these policies for cash growth if your intent is to make the minimum premium payment required. Basic permanent insurance does have its place, but it is not why we are here today. Permanent or cash value life insurance falls into one of three types of policies. As we just discussed, there's whole life. Again, that's where you pay a set premium amount for your whole life. There's variable life. That's where you're participating in market risks without any safeguards. And then there's universal life, where we can enjoy many features and benefits that the other two products do not offer. At Clear Diamond Life, we use a hybrid of universal life that even the most seasoned financial planners and even the majority of life insurance agents themselves do not know how to properly structure. And we're going to get to that in just one second. But first, it's important to note that this is not something we made up, or it's not a loophole that we're taking advantage of in the tax system. Just like your 401k, your 457b, or your 529e plans, those are all sections of the tax code that control how these plans work. Likewise, this slide represents the official guidelines created by the Internal Revenue Service that we must strictly adhere to and follow to ensure that we are able to take full advantage of all of the benefits this type of policy has to offer while keeping the costs associated with it as low as possible. The guidelines that we follow fall under the sections of the tax code as follows. Section 101 discusses how the death benefit or the wealth transfer is received to your family as income tax-free. Section 7702 states the definition of life insurance and how it provides tax-deferred growth on your cash accumulation, similar to your 401k. And then finally, Section 72E, this is the powerful one, it states that loans taken from a policy are not generally subject to income tax. The generally line is to make sure that this life insurance policy is properly funded and properly structured. The key word there is properly. Now, the life insurance vehicle that the wealthy have used for decades and the one that we focus on at Clear Diamond Life is the one we're going to focus on now. We like to use the phrase maximum funded, tax-advantaged index universal life. It is the number one tax minimization vehicle that exists anywhere when it is properly structured. The strategy that we use at Clear Diamond Life was actually created by E.F. Hutton for his more affluent clients. We have studied and implemented the strategy for years now, and we have discovered a way that it can work for almost anyone, regardless of wealth or income. And I'm going to show you an example of that in just a few minutes. At Clear Diamond Life, our team of wealth architects are experts at structuring these policies to comply with the complex guidelines set forth by the Internal Revenue Service that we just mentioned above. Now, maximum funded index universal life insurance is number one for three key amazing benefits. Number one is the tax-deferred growth so that your money grows uninterrupted through the miracle of compound interest, just like your 401k would. Number two is that it provides tax-free distribution so you can access your money for many purposes, including retirement income, down payment for a house, to start a business, basically anything you want to use it for, and without penalty. And number three is its ability to have all of the money transfer inside to your heirs completely tax-free. This is the only financial vehicle that can offer you all three of these incredible benefits while maintaining safety of principal, liquidity, and a predictable and favorable rate of return. So as we just mentioned, one of the biggest benefits is that this retirement vehicle can generate for you and your family tax-free retirement income rather than tax-deferred. But there's another benefit that is almost equal to it being tax-free, and that is the ability to use it for leverage. If you'll do me a favor right now and type the word leverage in the chat box, I want to cover this after the main presentation to save a little bit of time here. But using this strategy for leverage is complex, and at Clear Diamond Life, we are among the very few that fully understand how to take advantage of this. This benefit is without question one of the most powerful strategies this financial vehicle has to offer. In fact, there is not another financial vehicle out there that comes close to this benefit. Again, I want to circle back to leverage, and I'll cover this in the Q&A session for those of you that want to know more about it or have additional questions, because I could seriously spend an hour just talking about leverage alone. It is really, truly that powerful. But getting back to the life insurance component of this financial vehicle, maybe you have heard that life insurance has high fees, or it has hidden costs to it, or the rates of return are low, or you can't get access to your money. But what if I were to show you that life insurance actually has low fees, it has fully disclosed costs so that you know where everything is going, and the rates of return are very competitive to other financial vehicles in the market today. And most of all, you're able to access your money at any time and without penalty. That is what makes Clear Diamond Life different. We cover every aspect of this policy so that you fully understand every moving piece of what it is able to do for you and the costs associated with it. The thought of life insurance being used as a wealth strategy can seem rather odd, but we need to go back to what we learned in the very beginning. Remember that 84% of the revenue that the government generates comes from the top 25% of taxpayers. So this is a segment of people that all share a common problem. That is the amount of taxes that they pay. While the rest of the 75%, they all share another problem. And typically that's a money problem or a cash flow problem. And again, when you listen to the financial advice you hear on TV or radio or any other medium, they're actually talking to that bottom 75%. Because if you just think about it, if you were to host a TV show, wouldn't you be interested in gaining the most amount of people to watch your show? And if you were selling a book, wouldn't you want the most amount of sales? So the advice you hear through these mediums is typically very sound advice, but they're not talking to you or me. They're talking to the majority of Americans, that bottom 75% of the taxpayers. They're telling them how to handle their cash flow problems, but they're not addressing what we need to hear, and that is our tax flow problem. While the financial advice given to the top 25% is very different, we are focusing on how to minimize or completely eliminate the huge problem we all share, the taxes. Putting it all together, this is what's so good about Indexed Universal Life Insurance. It addresses each one of the three risks we have discussed so far. First are the stock market concerns. Indexed Universal Life Insurance includes what is called a lock and reset feature. What a lock and reset feature does is it allows you to capture the upside potential of the stock market without ever suffering the downside losses. This eliminates the bear market cycles altogether. Also, Indexed Universal Life Insurance addresses the tax concerns. It provides tax-deferred cash accumulations and tax-free distribution. This accumulation can be accessed at any time and without penalty for things such as retirement income, college tuition, a down payment for a home, or even a family vacation. This is where that leverage aspect comes in. Remember I said I would cover this after the main presentation during the Q&A, but just to give you a little teaser on this, imagine depositing money into a bank account that continues to earn interest on the original deposit even after you've spent more than 90% of the original balance. That's what I will show you. It's how you can enjoy uninterrupted compounding of interest regardless of how much money you have withdrawn from your policy. And lastly, we enjoy tax-free wealth transfer, as everything that remains in your account after you die will transfer to your heirs or beneficiaries or even charities completely tax-free, and typically it also avoids probate in most states. So if you've ever dreamed of leaving a legacy for your family or a favorite charity, or even thought about starting a scholarship fund, it can all be done with this strategy, and it's what we do for our clients each and every day at Clear Diamond Life. Now, Indexed Universal Life Insurance is so named that because the growth of the cash portion of the policy is tied to an index of your choosing. There are many indexes to choose from, but the most common is the S&P 500. However, there are newer and emerging indexes that may be a better choice depending on your unique situation. But right now I want to go over with you the lock and reset feature of an Indexed Universal Life Insurance policy, because this is where the magic happens. This graph on the screen is a typical stock market scenario, and it covers about 3 years. So let's say that you invested $100,000 in the market. The first year you did very well and you gained 7%, resulting in your account being worth $107,000. However, the very next year was bad and you experienced a 15% loss to your account, resulting in a year-end total of $90,950. Let's say the following year the market rebounded and gained another 5%. Your account now grew to $95,497. This is a snapshot of a typical stock market scenario. Now, let's compare that to the lock and reset feature of an Indexed Universal Life Insurance policy. Let's assume that our beginning balance for the first year again was that same $100,000. That year, the stock market went up 7%, so again, your account grew to $107,000. But look at this. When the stock market tumbled and experienced a 15% loss, your life insurance account locks in and it doesn't suffer any of those downside losses. It stays right at that $107,000 level and it never loses value. Then the next year, the market gains that same 5% and your life insurance account resets and it continues to grow. This is what we call the lock and reset feature in the Indexed Universal Life Insurance policy. This is one of the best features of this financial vehicle as it completely eliminates all market volatility. To illustrate this feature another way, let's look at this graph. This is the bull and bear markets. What the lock and reset feature of cash value life insurance does is that it completely eliminates that bear market altogether. You never experience those downside losses and only participate in the upside of the market. Sounds pretty good so far, doesn't it? Well, hang on, because it gets better. And it gets much better, actually. This was the diagram I showed earlier of investing $100,000 in the market over a 15-year period. At the end of the period, you would have ended up with $140,111. If you compare that to a properly structured index universal life insurance account after that same exact period, you would have ended up with over $241,000. The reason behind this drastic difference is because your life insurance account is linked to the stock market but never directly participating in it. So again, it receives a portion of the gains of the stock market, but when the market goes down, it doesn't experience that loss simply because of that lock and reset feature. At Clear Diamond Life, our clients love this feature as it provides the protection from loss during those down years in the market. Warren Buffett, one of the world's greatest investors, was asked how he makes his money, and he said rule number 1 was never lose money. Rule number 2 was never forget rule number 1. So the wealthy understand this, and they have been placing their monies into cash value life insurance accounts because of its unique and unparalleled crediting strategy for decades. Now, the strategy we're talking about here is a very unique type of life insurance, and it should only be implemented by a professional that has been highly trained in the strategy. If this strategy is not properly structured, it can have very severe tax consequences. At Clear Diamond Life, we specialize almost exclusively in implementing this strategy for our clients. By properly structuring this amazing financial vehicle, we can enjoy safety of principal or never having a risk of loss. We can enjoy the power of liquidity and leverage without penalty. We can earn a predictable and favorable rate of return. Eventually, we can enjoy tax-free retirement income rather than tax-deferred. And finally, all the money in the account will pass to your beneficiaries completely tax-free and free of probate. But here's what the wealthy, or the top 25%, do differently to make these policies work for them in their favor. They pay the minimum amount of death benefit, not $500,000, but only $150,000 in this case. Still, for the same amount of costs, $3,000 in this example. The reason being is that when they reduce the amount of death benefit as low as the Internal Revenue Service permits, this allows their account to maximize all the benefits we discussed earlier. No risk guarantees, liquidity, use and control, protection, leverage, tax-deferred growth, tax-free distribution, collateral, disability benefit, and wealth transfer. At Clear Diamond Life, this is where we differ from the typical financial advisor and the average life insurance agent, as we throttle back the face value or the death benefit to the minimum amount allowable according to IRS guidelines. This reduces the cost of the policy in exchange for maximum cash growth. This is just one of the many facets we will discuss with you when implementing your individual plan. Now, this is exactly how the wealthy structure their policies because they realize that they are not in this vehicle for the insurance factor, but rather for the opportunities that lie within these policies. In fact, one of our clients referred to the tax benefits and the growth potential of these policies as a banana split, and the insurance component of the policy was nothing but the cherry on the top. Now, as a side note, if it is insurance that you need or additional protection, we are more than happy to sell you a standalone life insurance policy supplemental to this one, and as we covered earlier, it will be much less expensive for more coverage. Now, let's circle back to the 3 ways that you can build wealth. We can now add the Index Universal Life Insurance Policy, or the IUL, to our tax-free bucket because, again, when properly structured, it can provide almost all the benefits we were looking for in our ideal financial vehicle. And as I just stated, the most efficient way to fund an Index Universal Life Insurance contract is to get as much money into the policy as fast as possible and in accordance with Internal Revenue Service guidelines in order to receive all the benefits that we have covered so far. Now, typically, we can accomplish this in as little as 4.5 years. Once the policy is funded, you never make another premium payment into the policy. So basically, at this point, you just sit back and you watch it grow while you enjoy the benefits of safety, liquidity, a favorable rate of return, tax-free distributions, and tax-free wealth transfers. However, if you remember that I also stated that at Clear Diamond Life, we discovered a way that we can implement this strategy for just about anyone, regardless of wealth or cash on hand, I want to show you an example of how we do just that for our clients. These clients didn't think they had the cash flow available to participate in this amazing strategy that we refer to as the number one tax minimization vehicle that is available today. What I'd like you to do now is to watch this brief video that one of our clients recently sent us and how this strategy was able to change their lives for the better. Now, because of the bandwidth that we're using right now, the video may lag with the audio a little bit, but just focus on the audio mainly if your video does lag, because I kind of expect that to happen.
Hi, my name is Richard Turner, and I just wanted to take a few minutes and share with you my own personal experience. You see, a few years ago, I thought I was doing everything right when it came to saving for retirement. My wife and I both work, and every month we would set aside a good portion of our income towards retirement. But the thing is that we were blindly contributing money towards things like 401ks and mutual funds without ever really considering how these accounts work and how it was going to affect us down the road. We attended a local seminar that this advisor was holding, and it really changed my life. It put things into perspective that I needed to sit down and really look at how my money is positioned to handle things like taxes and the stock market, and just making sure we have enough money throughout retirement. We loved the idea and the concept of indexed universal life, but I just couldn't see ourselves putting any more money towards retirement. But with his help, we found out we didn't have to. I'll always remember this. He said, "Richard, you're spending about $20,000 a year inefficiently." I was shocked when he told me that. There were three specific areas: our 401k contributions, our mutual funds, and the additional principal payments we were making towards our home. By redirecting that money towards an IUL policy, we now avoid stock market losses altogether, so we never have to worry about a crash ever again. We avoid paying taxes when we begin taking that money out during retirement, and we also don't have to worry about running out of money. I think the best thing about this was we didn't have to save any more money. He just assessed the things we were doing and showed us ways to make our money work more efficiently. I cannot thank him enough for what he did for me and my family. If you're watching this and you're thinking to yourself that you're where I was just a few years ago, please see what he can do for you, because he changed my life. He really did. And I'll always be thankful for that.
Every time I watch that video, it gets me really excited, as this is why I do what I do. Being able to make such a huge impact in the lives of our clients and their families is extremely satisfying for all of us at Clear Diamond Life. So let's take a look at the actual case design of Richard and Grace Turner. At the time when we implemented the plan, Richard was 46. He had 19 years until retirement, and both were employed. Richard's goal was to be able to retire at age 66. The first thing that Richard and Grace did for us was they completed their confidential wealth assessment. The wealth assessment allowed us to analyze their complete portfolio of real estate, cash on hand, retirement accounts, and investments. In fact, as you can see on your screen, I just made available to you a copy of the wealth assessment that you may download if you want to get started on your path to bucket number 3, our tax-free bucket. I will also cover the wealth assessment and the personal wealth report in more detail a little bit later in the presentation. So let's look at Richard and Grace's situation. When we first looked at the 401k contributions Richard and his wife were making, they were both contributing about $7,500 a year into these accounts. What we found out was that they were not receiving company matching. And a good rule of thumb when analyzing a 401k account is to only put up to your company match, and then consider other alternative wealth accounts that are more favorable when you compare it to what you would want in a financial vehicle. Since they weren't receiving a company match, we decided to redirect the combined account, which came to $15,000 annually. They opted to pay the taxes now instead of later because they assume that taxes are likely to go up. So in the end, it ended up being $10,000 being redirected. We then looked at their mutual funds. They were contributing $7,000 a year into these funds. Again, a rule of thumb for mutual funds and other liquid assets is to make sure you have enough assets liquid to cover your expenses for 6 to 12 months in case of any emergencies. Since they have enough assets liquid already to cover these expenses, and since they didn't want to be taxed every year on their gains any longer, they decided to redirect that money as well. So in summary, We redirected that $7,000 being put into mutual funds. The last item we looked at were additional payments being made to their home. They had an interest rate of 4%, but it was really ended up being 2.5% due to the tax deductibility benefit you receive when you have a home. With the low interest rate environment, they had been making additional payments totaling $3,000 a year. But with the tax deductibility benefit, they weren't really gaining much incentive. We decided to redirect the additional payments of $3,000 because we were very confident we could earn a higher rate of return inside their Index Universal Life Insurance account. So in conclusion, they were spending $20,000 inefficiently without even knowing about it. They thought they were doing everything right, but there were definitely ways to improve. Again, these were the three items we redirected. After-tax non-match 401k contributions totaling $10,000 after taxes, mutual fund contributions, which were $7,000, and additional principal payments, which were $3,000. In total, we were able to reposition $20,000 per year for the next 19 years into an Index Universal Life Insurance account for Richard and his wife without impacting their cash flow whatsoever. The biggest takeaway here is that Richard and Grace didn't have to change their lifestyle one bit. We simply redirected some of the things they were doing inefficiently and put that money into an Index Universal Life Insurance account. Now, we may not be able to do exactly the same thing for you as what we did for Richard and Grace, but I'm sure you can look at the things they were doing and be able to pick out one or two things that we could possibly help you with. So how did we get started with Richard and Grace initially? Like you, they saw the same presentation you are seeing right here, and they were highly intrigued. They completed the confidential questionnaire in great detail and scheduled an initial consultation where we discovered the items we just discussed in the above case scenario. The next step is where we really go to work for you. Based on the information that you provide for us, we will create a customized report which we call your personal wealth report. You see it up here on the screen right now. It is an in-depth 22-page report outlining areas for improvement. It will allow us to determine if Index Universal Life is a wealth account that should be added to a part of your well-balanced portfolio. This personal wealth report covers the costs associated with an IUL, and it also provides a historical look back at how it has performed throughout history. We will compare the IUL to traditional types of investments that we have previously discussed, and it will clearly display in an easy-to-read and understand format the potential dangers that you are facing with your current strategy and how you can make the adjustments necessary before it's too late. So in the wealth report on the screen, let's take a look at the breakdown of values and cash flows that are illustrated in this report. We're going to focus on the first half for right now. As you can see at the top, we have four sections. The one in green is Index Universal Life Insurance. The second in red is your taxable account. It could be any taxable accounts that we talked about earlier. The third in blue are your tax-deferred accounts, such as your 401ks and your IRAs. And the fourth in purple is a tax-exempt account. You typically won't even have a tax-exempt account that can put the amount of money that you can put into an IUL, but for today's sake, I want to compare apples to apples. Along the left side, you'll see the number of years that we have this Index Universal Life Insurance account for, the age of the person, Richard in this case, and the amount of money, or premium as it's called, that we put into each account. As you can see on the left, this illustrates that we are putting that $20,000 that we repositioned that Richard and Grace were spending inefficiently. We're going to do that for the next 19 years up until retirement. We're going to compare that with all the other accounts to see which one would hypothetically perform better. So let's flip the page because this is the most important part. Look at the taxable account. You can see by age 74, they've run out of money. With their tax-deferred account, the one in blue, you can see that by age 78, they would have run out of money. And in the purple column, the tax-exempt account, you would have run out of money at age 80 if you could have put that much money into the account to begin with. Meanwhile, the Index Universal Life Insurance account surpassed the other accounts and continues to blossom even by age 95. All the other accounts are at zero, and they have been for quite some time. So in summary, if we look at age 95, you can see that Richard and Grace would have deposited a total of $380,000 into their policy. The projection, again based on historical returns, shows us that they would have received $65,000 per year for the last 30 years, or a total of $1.95 million, which could be used for anything including retirement income, vacations, helping a grandchild with college tuition, really anything that you can imagine. And again, 100% tax-free. So again, starting at age 65, they were able to withdraw $65,000 per year for retirement income tax-free. And if anything should have happened to them, they still had the death benefit that would transfer to their heirs, again completely tax-free. How does that compare to your 401k? I wanted to show you this case because even though maximum funding is the ideal strategy for implementing an index universal life insurance account, you can see that by redirecting funds more efficiently over a slightly longer time, it has an equal benefit. What was interesting to me when I first heard about this concept was that this strategy is nothing new. Did you know that Walt Disney himself funded the construction of Disneyland using his cash value life insurance account? He was able to use the leverage, that word I talked about earlier, or the benefit to both collateralize and to borrow from his policy, and again without penalty. The best part about this was that the original basis continued to accrue uninterrupted compounding of interest. Another famous person that used the same strategy was Ray Kroc, founder of McDonald's. He took money out of his 2 life insurance accounts to help cover the salaries of key employees and also did an advertising campaign around the mascot we all know as Ronald McDonald. During the stock market crash in 1929 and the Great Depression, James Penny, owner of J.C. Penney, borrowed against his life insurance account to help the company meet their payroll and day-to-day expenses. And these are all examples of famous people who have used their permanent life insurance accounts to finance their expenses. Again, these are the strategies the wealthy have been using for decades, and it's how you can escape from the retirement tax trap as well. Now, this is a very complicated way to use this strategy, but in my opinion, it is every bit as powerful as the tax-free income benefit of an index universal life insurance policy. That is why it's imperative that you work with someone that knows how to properly structure your index universal life insurance account for the minimum amount of costs within the policy in order to enjoy the maximum amount of gain, all while keeping it in accordance with the IRS rules to maintain tax-free benefits of receiving income and transferring wealth to future generations, and again, to reiterate, tax-free. Okay, so here's what I'd like you to do next, and please listen very close. I implore you to get your own customized wealth report to get a clear outline of your personal wealth and to possibly identify areas of improvement. Folks, with Trump's proposed tax plan, we have a window of opportunity that we have not seen in decades. I think I'm going to coin the phrase tax sale because if you think about it, it really is just that. Taxes are on sale, and we all know that it can't nor will it last forever. So typically, we charge about $497 for a wealth report consultation. But we're not going to do that for anyone that's attending this training. All you have to do is complete your survey that you see on the screen now to get the ball rolling. Also, by completing the survey, you will get a replay link to this event so you can go back and review the areas you may want to study a little closer. So, what do you do next? Again, the key is to get an appointment set up with us immediately to get your free wealth report. And you do that by completing your survey that now appears on your screen. By completing this survey, you will unlock a sequence of events that we refer to as the True Wealth Transformation. The True Wealth Transformation is an 8-step process that all of our clients experience with us, and by getting to this point of the presentation, you'll have already completed step number 1, which is enlightenment. Hopefully, you've already experienced your aha moment or your epiphany, if you will, and if not, don't worry about it because that's okay, as some of our clients don't ever experience their epiphany until step number 4. So once you complete your survey, we're going to call you at the time you've selected to begin step number 2, which is our discovery process. You should see on your screen right now the wealth assessment. These are the questions you'll need to have completed for our call. If you don't have exact numbers at this point, don't worry about it as we can circle back to those numbers in future calls. But we do want to have a general idea of the approximate balances as this is what we will use initially to create your free personalized wealth report. Now, we will also use this time to answer any additional questions or address any concerns that you may have moving forward to the next step. After that call, and while we are creating your free wealth report, we will also grant you free access to our educational video library. This library consists of 13 professionally produced instructional videos that go more in depth into the strategies we touched on in today's presentation. These videos are short, they're concise, and again, by creating an account as soon as you receive your link, you will have free lifetime access to this video library. Now, there will come a time in the very near future where there will be a charge to have access to this library as we add more material. But again, by creating your account with the link provided, it will be free for you forever. So once we have created your personal wealth report, we will schedule another meeting where we will enter step number 3 of our 8-step process. That's called the strategic design. In the wealth report, we will show you where you are with your current financial retirement plan and the path that you are on. At that time, we will also have created a hypothetical example of something we might suggest, and we will compare that plan side by side with your current accounts based on the information that you provided to us in the discovery session. We will then enter step 4, the success formula. This is where we listen to your feedback and will address any concerns and answer any additional questions you have up to this point. We will then create a custom plan based on that conversation using real numbers that you have provided to us. Once we have your plan designed, we are then ready for step number 5, which is the refinement process. This is where we make any necessary changes or adjustments and we prepare alternative scenarios that you would like to consider. Once we decide in the final direction you would like to go, now we're ready to enter step number 6, which we call the action blueprint. This will be the final illustration that you have decided on, and once everyone is in agreement, then we then enter step number 7, which is implementation. This is where we complete applications and order any medical exams if required. We are now in the underwriting process, and once approved, the only thing left to do at this point is to fund the policy by making your first deposit of the policy to the carrier. Remember, you never pay us a dime for anything up to this point, as we are compensated by the insurance carrier once the policy is issued. Again, we are very upfront about the costs and the fees associated with these policies, so if at any time along the way there is something you don't fully understand or you want more clarification, please never hesitate to ask us. We will cover it as many times as it's necessary. It's highly important that you do understand everything, as we will be partners for many years to come, which brings us to step number 8, which is accountability. We will be meeting with you at least once a year, and it will typically be just after the anniversary date of your policy. We use this time to review the market performance of your chosen index and to talk about any adjustments that need to be made along the way. So, to take advantage of the number 1 tax minimization financial vehicle that exists today, it all starts by completing your survey. So complete yours right now, as it takes less than 3 minutes. 3 minutes that I can almost assure you that will change your life for the better. So get the wheels in motion, complete that survey, and transform your life immediately, for the future, and for generations to come. I sincerely hope that you have been listening with your heart as well as your ears, because if you don't take action right now, I know you'll be kicking yourself at some point in the future, because trust me, I've seen it. Now I want to leave you with this true story, as it's a note that I received from a potential client this last summer. I had left them a voicemail to follow up with them, as I hadn't heard from them in several weeks. It says, "Michael, thank you so much for your persistence with us. I do, however, regret to inform you that Barry developed sepsis after a routine procedure and passed away a week ago last Friday. I really wish we had taken your advice when we had the chance. My world has been turned upside down and I don't know where to turn. I know there's nothing you can do at this point. Thank you for your professionalism. All my best, Linda." Folks, I see these stories all the time. And you know what was the kicker? Neither Barry nor Linda had even the most basic of term life insurance coverage. They could have been approved without a medical exam on express underwriting. So please, I implore you, complete your survey right now and let us review your situation with you. You have nothing to lose, and this could possibly be one of the best decisions you have ever made in your life. There is absolutely no pressure, and if this is something you don't want to do at the end of the day, we will simply part as friends. I thank you for your time today. I look forward to talking with you on the time you've selected on your survey. Now, this is the end of the main presentation, and as promised, I'm going to stick around to answer some of the questions that Jeff has compiled for us. But here's the deal. If I don't get to your particular question, I promise you that I will answer it directly in an email to you. Again, we usually get about 70 to 75 questions during these events, so I'm going to try to dedicate about another 30 minutes for the Q&A session. But if you need a quick break, I do too, as I need to get a glass of water, so I will be back in 1 minute, so please don't go away. All right, so I hope everybody enjoyed that presentation and you took a lot of notes. And what we're going to do now is Jeff's been monitoring the chat room and he's emailed me a list of all the questions so I can see that he's got those. So Jeff, why don't you go ahead and just go from the top of your list that you have there, and we'll just take them in the order in which they came in, and we'll take them one at a time, and we'll stay on as long as we have time for. So go ahead and ask me question number one, and we'll get the Q&A session started here.
The first question is from Katrina. I am 66. Am I too old for this strategy to work for me?
Well, Katrina, we never want to say that anybody is too old ever, because we just really never know exactly what your situation is. However, if somebody is outside the ideal age range to do an index universal life insurance strategy, we do have other strategies that we can segue you into. For example, we do have a brand new annuity that just came out that is a no-fee annuity. There's absolutely no fee to it whatsoever. That's what used to give annuities a bad rap, was the fees associated with it. So this annuity actually has no fees. It's very similar in the lock and the reset feature of the index universal life insurance policy, and it also has a 20% deposit bonus on your initial deposits during the first year. So it's another strategy that can work exactly like the IUL, except for the fact that you do not have the tax-free retirement income, nor do you have the death benefit. However, it is a byproduct of things that we will work with if somebody is either too old for the ideal IUL strategy to work, or if they have health conditions that would otherwise preclude them from being approved. So the important thing is to always fill out your survey and to get us your information so we can analyze your situation and schedule that appointment with us.
Our next question is from Martin. Is this a variable product?
Well, Martin, I'm assuming that this question came from earlier in the presentation, but absolutely no, this is definitely not a variable product. In fact, in 2006, I believe it was, I drew a line in the sand and I told myself that Clear Diamond Life would never have anything to do with a product where our clients could possibly lose their money. So therefore, at Clear Diamond Life, we're never going to suggest or represent any products that are variable in nature, nor do we have any money under management. In fact, I don't even have a securities license for that exact reason. However, depending on the Department of Labor ruling that is currently being reviewed, we may be forced to hold a security license in order to assist our clients with qualified account rollovers to annuities. But again, that would be the only reason. So to reiterate, at Clear Diamond Life, we do not offer nor do we sell or represent any product that is a variable product where you could possibly lose any of your money. We leave all that up to the money managers or your financial planners. So we only want to focus on the portion of your portfolio that you cannot afford to lose.
Next, a question from Nate. Could I set this up for my grandkids?
Nate, absolutely. We assist many of our clients with this strategy actually under our legacy planning umbrella. And as it says in our mission statement, we don't just make a difference in people's lives today, but we have a resounding impact on tomorrow, the future, and for generations to come. So not only can you set this up for grandkids, you can also set it up for your children directly as well. So again, it really depends on your unique situation and what it is you're trying to do. So again, complete your survey, put that in the special comments section that you would like to focus on doing this for your grandkids or your children, and we'll pay special attention to that note. So when we chat with you, we can discuss exactly what it is you're trying to do. But bottom line, the answer is yes, absolutely. You can set this up for just about anybody, including charities, foundations, animal shelters, your college, your university. Really, any place you want to leave your money to, we can assist you in that arena very easily.
Our next question is from Amber. I have a 401k from a previous job. Am I able to transfer that into this plan?
Amber, I'm really glad you asked that question because this one comes up quite a bit at our live events, and there's a lot of moving pieces to the answer. But the bottom line is, if you're under age 59 and a half, you will not only have to pay taxes on that transfer, but you will also have a 10% penalty if you are under age 59 and a half for taking that money out early. So we want to pay very close attention to your exact unique situation, because sometimes it would make sense to do that, and then there's other times where it absolutely would not make sense to do it. So again, in your survey, when you fill that out, put that in your special comment section that you do have a 401k rollover that you're considering cashing out from a previous employer, and we want to pay very, very close attention to that. Now, if you are over age 59 and a half, with Trump's proposed tax plan, there is a pretty significant window of opportunity where it will make sense for a lot of people to do that if you believe that tax rates in the future are going to be higher. Because if we pay those taxes now, get that money out of the markets where it's at risk, and put that money into a vehicle where it's completely safe and will participate in the markets without being at risk in the markets, there probably could not be a better time in our history if you remember what those charts look like when you look at the history of tax rates. Now, there is a national CPA by the name of Ed Slott that appears on PBS programming regularly, and he fully endorses the maximum funded index universal life insurance contracts for this exact reason, because his belief is that if you get your money out of these accounts now while the taxes are lower, it's going to be very favorable. In fact, he refers it to moving your money from accounts that are forever taxed to accounts that are never taxed. So again, age has a lot to do with it, and we want to really, really take a look at it to see if it makes sense for your particular situation.
Next question is from Penny. We live paycheck to paycheck. What can we do?
Well, Penny, again, remember, everybody's situation is unique, but it sounds to me like you may be in that bottom 75% of wage earners where you may want to act upon the advice from the other financial entertainers that I referred to earlier, such as Susie Orman and Dave Ramsey, because like I said earlier, they do offer great advice for assisting people with knocking down debt and establishing savings plans. And then once you're in a position where you have at least 6 months in reserves and you're able to contribute, let's just say, at least $500 a month to retirement savings, then at that point, we would be more than happy to assist you. But we never want to put the cart before the horse and make somebody's situation even worse for them. So if you don't have at least 6 months in reserves, and you truly are living paycheck to paycheck and you're not able to save any money, now would be the time to really focus on paying down credit card debt and managing your money that way first before we even look at these type of strategies. So again, I want to reiterate that everybody's situation is different and unique. So if that's what your question was pertaining to, that's what my advice would be. Now, if you do have money that you are currently contributing to a 401k plan and you're contributing more than your employer match contributions, just like in the Richard and Grace Turner video that we watched, we may be able to reposition some of your other funds if you do have those funds available to use that money more efficiently. So again, if that's the case, complete the survey, fill out that financial questionnaire, send it over to us, and again, we'd be more than happy to look at it for you.
The next question comes from Jackson. I've heard the phrase buy term and invest the difference. Why is this better?
Well, Jackson, I think we went pretty deep into that question during the presentation. But again, if it's basic insurance that you're looking for, this is definitely not the strategy for that purpose. Because remember, when you're making that minimum premium payment allowed in cash value life insurance, this is not a wise financial decision if your goal is for cash growth. Now, if your goal is to have insurance, we're more than happy to sell you a standalone policy for those purposes. So again, in this strategy, we are advocates for maximum funding in index universal life insurance contract, again, to enjoy the long-term tax benefits and the leverage that the strategy affords while we enjoy uninterrupted compounding of interest. And again, we can go much deeper into those benefits of the strategy, and we do so in our educational videos that you now have free lifetime access to once you complete and return your confidential wealth assessment. So at the very least, complete your information, send it over to us so we can give you access to that video library so you can dive deeper into these strategies if there's some part of the presentation that you didn't understand or some part of the strategy that you missed earlier. But again, buy term and invest the difference. Why is this better? This is better because we're not doing it for the maximum amount of insurance that we can buy with our money. Again, if you remember, what we're doing is we're throttling back that death benefit or that face value of these policies to the minimum allowable by Internal Revenue Service guidelines so we can have the least amount of costs for the maximum amount of cash growth. That's where the strategy will almost always outperform a 401k plan or any of the other investments that we can compare these things to side by side. So again, when you get your confidential wealth assessment after you submit your survey, you will see how we compare these different accounts side by side with each other, and then we will prove to you why and how this will outperform almost every other financial strategy that you have access to currently.
The question from James, what does maximum funded mean? How does max funded work?
Jane, here's a question I was really hoping someone would ask, and it kind of shows me that you were actually paying attention to the presentation. So, and it's also a continuation of the previous question that we just had. So basically when we say maximum funded, that means we want to get as much cash into the policy as fast as is possible under the guidelines established by the Internal Revenue Service in order to keep the policy in a tax-favored status. So typically, it's going to take between 4 and 6 years to maximum fund a policy depending on your age. But as an example, let's say we were going to fund a policy with a total premium of $100,000. That's how much money you had to put into the policy. It's going to take us about 5 years to fund it. That means we could only deposit $20,000 into the policy for the next 5 years. So again, what we're trying to do with these policies is to get as much cash into the policies as fast as we can, and again, in accordance with those guidelines that we showed earlier in the presentation that are set by the IRS, which are Section 7702, Section 101, and Section 72E. And again, this strategy is very, very complex, and you want to work with somebody that is highly trained and highly skilled, like we are at Clear Diamond Life, in implementing these strategies properly. Because if you remember, all agents have access to these types of policies, but not all of them know how to structure them properly for the maximum cash growth and the least amount of costs. So once again, complete your survey, submit your information to us, and we'll be happy to analyze your unique situation. Jeff, what's the next question you have?
LaShawn asks, is this whole life?
LaShawn, this is probably another question that came on early in the presentation. So again, when we covered the permanent types of insurance, we had whole life, we had variable life, and then we had indexed universal life. And this is really what this strategy focuses on, is using exclusively indexed universal life, opposed to whole life, where remember you have that minimum premium payment you make for your whole entire life, and the costs associated with the policies are much higher because they're not structured the way that we're structuring the index universal life insurance strategy by maximum funding it. So again, no, it's not whole life. This is exclusively indexed universal life.
Our next question comes from Akio. I have an existing whole life policy. Is there anything that can be done with it if I want to transfer it?
Jeff, I didn't catch that name, but I think you said Akio, and if I'm mispronouncing it, I really apologize. But Akio, if you have an existing whole life policy that's been in effect for quite some time, and you don't think that it's structured properly, or you think that that money's not being used absolutely efficiently, that's another situation that we can absolutely take a look at for you, and we can do what's called a policy review and make sure that that policy is structured efficiently for you. And if it's not, you can do what's called a 1035 exchange directly into the index universal life insurance policy that you're starting and establishing. So that money is transferred. 100% of that cash value goes directly into the policy immediately, and it doesn't have any limitations on the funding of the rest of our policy as far as how fast we can put money into it. So that's you kind of get an exemption from the amount of cash value that you currently have built up into an existing whole life policy. Or also sometimes we even find some of those old universal life insurance policies, like we referred to in the presentation, that E.F. Hutton created for his clients back in the day when you didn't have the IRS limitations. And sometimes those even present opportunities for us. So again, if you have existing policies, those are definitely something we want to review when you fill out that personal information on that survey, and list those policies, because we want to look at each and every life insurance policy you have currently, whether it's cash value life insurance or just regular term insurance. And I hope that answered your question.
Our next question is from Michael. I don't have a family. Why would I need a death benefit since I have no one to leave my money to?
Well, Michael, obviously you're focusing on the death benefit or the wealth transfer phase of this strategy. And the simple answer is that while you may not have a family member to leave your estate to, many of our clients will list their favorite charities, universities, animal shelters, city parks, or really any organization that you can think of that could benefit from the wealth transfer of your life insurance policy. So, it is a wonderful way to create that legacy for yourself. But again, that real reason that we're using this strategy is for the market gains and the living benefits the strategy has to offer. And that's really the main reason. And kind of like we said earlier, the life insurance component of this strategy is nothing but the cherry on top of that banana split. So the legacy part of the strategy is one of the main aspects that we're very committed to at Clear Diamond Life, and that ability to make such a profound difference to future generations. But again, the living benefits is really where the strength and the power of the strategy comes from. And I think you'll see exactly what I'm talking about once you receive your personalized wealth report, where we list all the accounts side by side and we compare apples to apples with the index universal life insurance strategy compared to your 401ks, compared to your Roths, compared to your other tax deferred accounts and your other tax-free accounts. And it's at that point that a lot of people have their first epiphany when they actually see that their money in this strategy will last into perpetuity compared to the other accounts where their money actually will run out, typically starting at age 72 to 75, and they're completely out of money in the 401k, or they're completely out of money in their tax-exempt accounts in their early 80s. Where not only does this money continue into perpetuity, but then again we have that death benefit that does transfer, if not to your family, to whatever charitable cause or foundation that you want to create. So it is an extremely powerful strategy from that standpoint.
Our next question comes from Cameron. It's really more of a statement than a question, but we'll still address it. It says, I heard the commissions were really high and the fees are also high.
Well, Cameron, you are absolutely correct in the fact that these policies can have high fees and they can have high commissions. In fact, that's where that phrase that we referred to earlier, buy term and invest the difference, originally came from, because agents that are not properly trained in this strategy have really given it a bad name because of that fact. So again, what we do differently at Clear Diamond Life is we reduce that death benefit to the minimum allowable by Internal Revenue Service guidelines to take advantage of the living benefits the policy has to offer. Again, that is liquidity, safety, favorable rate of return, tax-free retirement income, and tax-free wealth transfer. So again, by reducing that death benefit or that face amount to the minimum allowable by Internal Revenue Service guidelines, we are going to keep those policy costs and fees about 30% less than somebody else that would structure this policy without the knowledge that we have at Clear Diamond Life.
Okay, our next question comes from Lloyd. Is there a limit to how much money I can put in?
Well, Lloyd, we rarely run into a situation where we have someone that wants to put more money into it than they would otherwise qualify for. But to answer the question, yes and no as far as are there limits. So here's how it works. everybody has what they call maximum insurability. So you have to qualify for the amount of insurance you're applying for. And what I mean by that is, let's say that you're a single male and you want to apply for a face amount of $5 million, for example. Unless you have significant assets, you're probably not going to meet the underwriting guidelines that would justify the need for that much insurance. However, almost anybody will qualify for at least $1 million worth of face amount. And remember, what we do differently at Clear Diamond Life is we reduce that face amount down to the minimum amount allowable by Internal Revenue Service guidelines. So let's just say that you thought that you were going to need a $5 million policy. Well, you may in fact only need a $2.5 million policy by the time that we reverse engineer all the numbers to get that death benefit down to the minimum amount allowable to reduce the cost and the fees associated with the policy. So again, yes, there are limitations, but rarely do we come into a situation where somebody wants to put more money into a policy than what they would otherwise qualify for.
The next question comes from Chin. What if I have health issues?
Well, Chin, that's another great question because it's a multifaceted answer. So if somebody has health issues that they perceive that they have, actually the underwriters may have a different opinion than you do. For example, we actually had a client recently that had had a heart attack more than 2 years ago, and they didn't think that they would be approved, and they were actually approved for a favorable rating. So you just never know what somebody's situation is. So we always want to make sure that we take a full look at exactly what your situation is, what your health issues are, and if you do have health issues that preclude you from participating in this strategy, remember we do have other financial vehicles that are almost just as good as the Index Universal Life Insurance strategy in the form of the no-fee annuity that I referred to earlier. Annuities get a bad rap a lot of times because of the fees associated with them. Well, this particular annuity that we have has got no fees whatsoever. It has a 20% deposit bonus, and it is a fixed indexed annuity where you would never lose your money. And it operates almost exactly the same as the Index Universal Life Insurance strategy with that lock and reset feature. The only downside is you're not going to have that tax-free retirement income, even though you do have a death benefit transfer within that annuity. Now, there is another product we have called a structured cash flow for somebody that would not otherwise qualify for the IUL strategy, or they may not want their money to be locked up for 10 years with the annuity strategy. So there is a way that we can help almost everybody regardless of your situation. So again, complete your form, send that survey in, and let's get your personal wealth report created for you so we can look at everything side by side.
Our next question is from Hayo. How is this tax-free income?
Well, Kyle, if you remember in the presentation, this is one of the main reasons we do this strategy is for that tax-free retirement income. And again, those guidelines are clearly defined by the Internal Revenue Service under those 3 sections of the tax code that we referred to within the presentation. Again, we go deeper into this strategy in our video series that you have access to by completing your survey and sending us your information. So again, send us your information, complete that survey so you have access to the videos where you can go back and get more in-depth information, and you'll also get a replay link to the webinar that we're going through right now. And that way you can go back and cover that section again.
Jacob submitted the next question. I like the concept, but where can I find more information?
Jacob, if you go to our website, which is www.cleardiamondlife.com, and click on that resources tab, you'll find a list of all of our other third-party articles, books, and other information we'd like to have our clients review. Also, our video library is very extensive. We go very, very deep with additional information on these strategies. So again, if you've completed your survey and your wealth assessment and sent it to us, you now have access to that video library. There's 13 of them, I believe, and they're about 12 minutes long each. And we go very, very, very deep into this strategy because we want to make sure that you're fully educated before you decide whether or not this is right for you. So again, www.cleardiamondlife.com and click on that resources tab. One of my favorite books that I like to refer my clients to is a book by Patrick Kelly, and it's called The Retirement Miracle. I highly recommend my clients read that book as well because it is an independent third-party review of this strategy. Another independent third-party source is that CPA I referred to earlier. His name is Ed Slott, so it's ED SLOTT, and Ed appears regularly on PBS programming He's not only an ambassador for the strategy, but he advocates it to his clients as well. Jeff, what do you have next?
Our next question comes from Padmakar. Is there a charge to meet with you?
Jeff, I'm sorry I didn't catch the name for that question, but the answer to it is there's absolutely no charge whatsoever to meet with us ever, because we get paid directly by the insurance company only if we implement a plan for you. And remember what I said earlier is we're going to reduce that death benefit to the minimum amount allowable by Internal Revenue Service guidelines, so that also reduces our commissions compared to somebody else that may do this strategy for you or attempt to do this strategy for you and not structure your policy properly. Because remember, at Clear Diamond Life, we're going to do everything possible to minimize the fees of these policies because we want to make sure that our cash growth is the maximum it can ever be. So again, there's absolutely no charge to meet with us ever. And the other thing is, you will never send money to us for any reason. So whether you're implementing the Index Universal Life Insurance strategy, or you're purchasing an annuity, or you're doing a structured cash flow, your money will never transfer to anybody at Clear Diamond Life. It goes directly to the insurance carriers. So again, absolutely no fee to meet with us whatsoever. Great question.
Our next question is from Olaf. I am in Minnesota. Do you have offices here?
Well, Olaf, even though we don't have an office in Minneapolis at this point, Jeff has actually just moved back to that area, and our plan is to open an office in Minneapolis later on this year. However, typically we meet with most of our clients online or through web-based meetings, but that doesn't mean we don't want to meet with you in person. So we do have clients that will fly to our main offices in San Diego. We also have an affiliation with the Live Abundant group out of Salt Lake City as we run the Live Abundant radio show in the Las Vegas market. We also have an affiliation with one of our offices in Columbus, Ohio. So if we ever do need to meet with you in person, flying to one of these locations is a definite possibility.
Our next question comes from Wendell. What insurance company do you work for?
Wendell, at Clear Diamond Life, we are an independent firm and we represent over 50 of the top insurance carriers in the nation. However, unlike a captive agent, we are able to shop for the best products for your particular situation. So we're not just limited to, say, MetLife, Farmers, or State Farm as an example. And for this particular strategy, the majority of our business is actually placed with 3 of the top rated insurance carriers in the country. So it really depends on exactly what it is we're trying to do for you. But just know that we're able to shop for the best product for you, and we're not limited to having a specific set of products that another agent may be bound to.
Next up, from Elizabeth. How can the insurance company do this?
Well, Elizabeth, this question is simple on one hand, but complex on the other hand. Now, we do cover this in depth in video number 11 in the video library that you have access to once you complete your survey. But just real quickly, for every $100 of premium that you pay, $95 of that goes into the insurance company's general portfolio, and that portfolio is very well balanced and conservative in nature. So the insurance companies know that this fund will yield a return that will get them back to their original $100 investment. So the other $5 that they have, that goes into options where those returns can be 10, 12, 13, 14% or beyond. And since we don't have a lot of time to go into it, again, you can find more information on this in video number 11, or we can discuss it in much greater detail during your appointment.
Our next question is from Beatrice. This really sounds too good to be true. What's the catch?
Well, Beatrice, there really isn't a catch. Cash value life insurance products have been robust financial vehicles for decades, and they should absolutely be a portion of your well-rounded portfolio. But I guess if I were to think of a catch, maybe it would be that it ultimately is insurance and you need to be able to qualify for the coverage that you're applying for. So just because you have the money doesn't necessarily mean you automatically get to participate in the strategy. However, at Clear Diamond Life, rarely do we encounter a situation where we're not able to help somebody in some way, but this is a very carefully designed strategy, and when combined with other financial vehicles that you have, it does create a very balanced and well-rounded portfolio, and it's one that should be part of everybody's financial strategy.
Our next question comes from Javon, and is really quite interesting. My son is a soon-to-be professional athlete and has a substantial signing bonus coming his way. This sounds like a perfect place for his money so that it can grow and be available for him at retirement. Am I right in my thinking? I don't want him to end up like Dennis Rodman or the like.
Wow, Jovan, that is a pretty intense question. So just to let you know, among our clients are many entertainers and professional athletes that have taken advantage of this strategy. These type of candidates are ideal for maximum funding a policy as they typically have the immediate resources to fully fund their policies and as fast as possible in accordance with the IRS guidelines that we want to maintain for the living benefits and the tax-free retirement income. But this is where the power of that compound interest and leverage really supercharge these policies because the growth potential is so great, and this is how these individuals that maximum fund these policies provide for their future. They form foundations, they donate to charities, provide for their families for many generations to come. So when we think about the amount of money they have to put into these policies, sometimes we see policies that are 10, 15, $20 million deposits over the course of 4 to 5 years. Let's just say that we had $10 million that we were going to put into this policy over the next 5 years. So basically we would be putting $2 million per year for the next 5 years into the policy. Well, using the rule of 72, we know that if we're going to average, say, 7.2% return on our money, it's going to take us 10 years to double our money. So I'm assuming that your son is probably 21 to 22, somewhere in that age range. By the time he reaches age 25 to age 26, he's going to have all of his money deposited into his policy to where he never has to make another premium payment. Now, when he's ready for retirement at age 65, we know if he's averaged 7.2% rate of return, that money has now doubled itself 4 times. So that $10 million is now worth $160 million. So imagine being able to access $160 million tax-free. How long could you live on that money? Now, I know that's an extreme number, and it's an extreme example, and that's exactly what the wealthy have been doing for decades. Now, again, our target audience is anyone that makes over $168,000 per year in combined family income because they are typically in that top 25%. So can we help your son with this strategy, and is it a good idea for him to do that? Yes, absolutely, because now what he can do is he can guarantee that he will never outlive his money, and he won't end up like people like Dennis Rodman. So I'm trying to remember this right off the top of my head, but according to Sports Illustrated, I think they said that 78% of all NFL, and I believe it was 60% of NBA players go bankrupt or they're under financial stress within 2 to 5 years after their retirement from their respective sport. So by implementing a properly structured, maximum funded, tax-advantaged, index universal life insurance contract, it can definitely protect them not just into the future, but for generations to come.
Our next question comes from Lorraine. Are there penalties for early withdrawals?
Lorraine, no, there's absolutely no penalty for early withdrawals when we're talking about the index universal life insurance strategy. Again, that's one of the main benefits of this strategy is that you can access your money at any time in the form of policy loans without penalty. Again, I just want to reiterate that this is a very advanced strategy and we want to discuss it with you in great detail. The other advantage to having penalty-free access to your money is that there's not a set payback schedule. However, remember, if you withdraw the money early and you don't pay it back at some point in the future, the policy may not perform as we originally illustrated. That's why we have our annual review, and we want to review with you everything that is going on in your life at least once a year so we make sure that we stay on track with every moving aspect of the strategy. Again, that's why you want to work with somebody that's highly trained and experienced in implementing the strategy for you.
The next question is from Kathy. Would having a policy like this count against me to qualify for college financial aid?
Kathy, this is a great question because it brings up something else I wanted to cover. But essentially the answer to your question is no. Cash value life insurance is actually exempt from FAFSA disclosure requirements in most cases. And this is what Jeff specializes in, is using this strategy specifically for college planning purposes, as it is a much better option, in our opinion, at least for the top 25%, compared to the 529 plans. There's many moving parts to using this strategy for college planning, but properly structured, it does have incredible possibilities. In fact, many of our clients, they didn't think that they could actually qualify for college aid have actually received thousands of dollars in financial aid that they otherwise would have had to take from their own pockets by transferring money from various accounts. So again, if there's someone in your family that is getting ready for college, let us know in the special comments and we'll be sure to enlighten you on that topic. The other thing to circle back to is for the grandparents that had that question earlier, these are perfect strategies to implement for grandchildren because by the time the grandchild has reached college age, which is typically around age 18, that money may have already doubled itself twice, and now we can use that in the form of policy loans to fund the college education where that money has no set payback schedule and it can be paid back at any time in the future while that original deposit in the account continues to grow using compound interest. So it is an incredible strategy for college planning.
The next question is from Jigs. Is this something my financial planner can do for me?
Well, Jigs, that's what I keep emphasizing over and over and over is even though most agents and financial planners may have access to the carriers that we use to implement these strategies, they are definitely not experienced in implementing them properly to minimize the costs associated with the policy. So it's possible that they could do it for you, but it's highly and extremely doubtful. This financial strategy is our main focus at Clear Diamond Life. And again, we are highly trained and highly skilled in ensuring these policies are structured properly for tax compliance purposes, as well as minimizing the overall policy costs by ensuring that the amount of insurance being purchased is the smallest amount that is required according to the Internal Revenue Service requirements. And once again, I want to reiterate that as we stated during the presentation, we're not looking to replace your financial advisor or your insurance agent by any means, but this strategy should be in addition to your overall balanced portfolio, and we only want to help you with the portion of the portfolio that you cannot risk to lose. So we have found that when you do use your advisor or your own insurance agent to implement this strategy, that the commissions and the fees are much higher, not allowing the policy to perform as illustrated. So again, this is all we do at Clear Diamond Life. It's our sole focus. So I guess the question back to you would be, if you needed heart surgery, would you want to use a doctor that was a cardiovascular surgeon, or would it be okay for your family doctor to perform the procedure? So I hope you get the picture. Your financial advisor has a lot to keep up with when it comes to managing your money, and learning and implementing the strategy takes years and years of training, just like the surgeon. And this is where we are experts at Clear Diamond Life. So I hope that answered your question.
Our next question comes from Dexter. I don't have a lot of money to start a plan like this, but I know I have money coming to me. Are there any other options?
Well, Dexter, we never want to put the cart before the horse, but if you remember from Richard and Grace's video, we were able to find additional money that they were using inefficiently to help them fund their policy. Now, there are other circumstances where people think that they have money coming in the future in the form of signing bonuses like we heard from Javon earlier, or they may have a family inheritance coming their way, or they may have a bonus coming, but we never want to plan on that money when we're implementing a plan or looking at the strategy until we know that we actually have the money in our hands, because too many times in the past we have seen people that thought that they had money coming and it never arrived, and if they would have had a policy structured in anticipation of that money, it would have led to nothing but disappointment for everybody involved. So no, we never want to work at perceived money that may be coming in the future. We only want to work with money that we have in our hand, or that money we can find that may be being used inefficiently. So Jeff, I know I've gone more than 30 minutes so far, but these are all pretty good questions. So let's take a few more questions and we'll just go ahead and keep this going, and we'll probably wrap it up at a full hour just for the Q&A session, because I really think it is valuable content. And since there are so many questions, I just want to try to hit as many as we can. And for those of you that are listening at home, remember, we are going to send you a replay link so you can go back and listen to this at your convenience. So you can slow it down and take notes and pause it wherever you need to, because before we schedule your appointment, we want to make sure that you're as educated as you possibly can be, so it saves time for us and it saves time for you as well, and we can use our time much more efficiently that way. So Jeff, let's go ahead and give me a few more questions here, and then we'll wrap it up right at the hour break.
Our next question comes from Deanie, and it's really more of a statement, but we'll address it anyways. She said, "This sounds like some sort of a tax loophole."
Well, Deanie, this is actually anything but a tax loophole, and I know we already covered this, but again, maximum funded, tax advantage, Universal life insurance contracts have been used by the wealthiest individuals both for business personally and to protect and grow wealth for decades. So this strategy is fully defined under the IRS sections 7702, 72E, and 101A of the tax code, similar to how they've defined rules under section 401K of the tax code for the plans most people are familiar with. So it's definitely not a loophole. It's just that we have learned how to maximize the advantages under these IRS guidelines to make this strategy outperform most 401ks and other retirement types of plans for the purposes of liquidity, safety, favorable rate of return, tax-free retirement income, and tax-free wealth transfers. So no, it's definitely not a tax loophole.
We have another statement question coming as well. This one's from Fam. It looks like you're simply trying to sell life insurance.
Well, fam, again, not at all. In fact, if life insurance is what you want, this is definitely not the program for you, and we covered this in the presentation. But again, using this strategy, the life insurance component just happens to be the vehicle that allows us to take advantage of the benefits this strategy has to offer. So again, we look at the life insurance component or requirement portion of this strategy as that cherry on top of that banana split. It is what protects you ultimately in the end from any risk of loss while you put yourself in a position to enjoy the leverage, the uninterrupted compounding of interest, and the tax-free living benefits this strategy has to offer. Again, I want to reiterate that at Clear Diamond Life, what makes us different from everybody else is we know how to throttle back that death benefit to the minimum amount allowable by the Internal Revenue Service to stay in compliance with those very complex tax codes we have been referring to throughout this presentation.
Our next question is from Lucia. Why haven't I heard about this before?
Well, Lucia, this is actually kind of funny, but the first time I heard about this strategy, and I was being trained on the strategy back in 2006, I asked that same question, and the response I get was I was told that I needed to get out more. But actually, the advantages of maximum funded tax advantage life insurance is really no secret. The strategy is very complex for the average financial planner or financial advisor to implement properly without having years of training or experience. And sadly, many financials and tax professionals that have not done their research on the intricacies of what we teach, they end up demonstrating resistance to the strategy due to their lack of understanding and education versus reality and facts. And we have found that this is especially true when it comes to understanding the long-term tax benefits and the internal rate of return that is actually being achieved. Now, your financial professional has more than enough on their plate already, and they have many things that they're responsible for in growing your money. At Clear Diamond Life, this is the only thing that we focus on. And again, we want to focus on that portion of your portfolio that you cannot risk to lose. We have assembled the top team in the nation at designing and implementing the strategy, and behind the scenes in our San Diego office are about 30 of the brightest minds in the insurance industry. Their sole focus is understanding, studying, designing, and refining your index universal life insurance plan. And yes, we may do a few annuities here and there or a structured cash flow from time to time for people that can't qualify for an index universal life insurance, but all in all, the majority of what we do is this strategy and nothing else. In fact, in 2016, our office in San Diego protected 4,347 lives with this strategy, resulting in over $270 million in assets protected, either through an index universal life insurance strategy or an annuity. So again, the strategy has been around for decades. So there's an old adage that says, what you don't know, you don't know. Well, now you know that there's a better place for your money. And one of my favorite phrases is good, better, best, never let it rest until good gets better and better gets best. So when we talk about our 401ks, that's a good strategy. When we talk about our tax-exempt accounts, that's a better strategy. Now when we're talking about a tax-free opportunity or strategy, in our opinion at Clear Diamond Life, that is the best place to put your money.
Our next question comes from Matthew. Can you please explain what the average rate of return is?
Matthew, that's really a great question, and this is one that I really want you to pay close attention to, because many advisors tout that their clients earned an average rate of return of, let's say, 8% during the last 10 years of all this economic turbulence we've been through. While that may sound great, it doesn't necessarily mean that you would be ahead. So here's an easy example. Let's say that you had initially $100,000 under management in an account, and in year number one, you suffered a 30% loss resulting in an ending balance of $70,000. Now let's say year number 2, you had a 50% gain, resulting in an ending balance of $105,000. That's an average rate of return of 10%. Likewise, if you had that same $100,000 in an index strategy, and let's say that in year number 1 you had a 10% gain, resulting in an ending balance of $110,000, and in year number 2 you had another 10% gain, the ending balance would be $121,000. But guess what? That too is an average rate of return of 10%. But in investment number 2, you had $16,000 more than you did in investment number 1. So which one would you choose? That's what an index universal life insurance strategy will guarantee you, is it takes away that market volatility. So when we look at average rates of return, we know that we're looking at true numbers because it allows you to participate in the gains without the risk of any of those losses whatsoever. Again, this may be really hard to comprehend, but if it's something you want to circle back to, we can definitely do that during our meeting. So again, fill out your survey, complete that questionnaire, get it back to us, schedule an appointment, and we'll be happy to sit down and explain exactly how that works for you.
Next up from Dana. So, is this considered an investment?
Dana, no, life insurance contracts are never to be considered an investment, nor should they ever be classified as such. They are, however, a very powerful financial strategy that should be part of your overall balanced portfolio because they will yield you stable wealth accumulation through tax-deferred growth, tax-free retirement income. You're able to access your money at any time. And when structured properly, your money will last into perpetuity. But again, we never want to consider them to be an actual investment because they're not classified as an investment. This strategy is classified as life insurance. So we just want to be very, very clear on that.
Our next question is from Javier. Is there a better time of year to start my policy?
Javier, no, there's actually not a preferred time of the year to start a policy because if you remember when we covered the lock and reset feature of the strategy, the lock and reset is an annual reset. Therefore, it really doesn't matter if you start today or in 6 months, as whatever date your policy goes into effect, that will be your annual, what we call sweep date. That is the date the gains are swept into the account and we reset for the next year's market activity. So we've actually taken some time and we've analyzed data over the last 20 years to really see if there were any trends that seemed to be better dates than others, but there really wasn't anything that was noteworthy to mention for best start dates. So we always say it's best to start today because we do want that compound interest working for us as fast as possible.
Another question from Adam. I have some money right now, but I know I have a lot more coming to me within the next 2 years. What is the best advice?
Well, Adam, if you remember from earlier, I always say that you don't want to put the cart before the horse. And remember also that to fully fund or to maximum fund a policy using the strategy that we recommend, it does take us about 4.5 to 5 years. So if you know for absolute certain and beyond any shadow of a doubt that you do have the funds necessary to fully fund the policy within that time frame, I would say that it's probably best to start the policy as soon as possible because our buckets can always be backfilled if your funds are delayed. Now, we would only want to do that so we don't have lost opportunity as far as time is concerned. However, if there's any doubt whatsoever that the funds may not be received, I would caution you to only start a policy that is sized accordingly with the known money that is currently available, because we never want to shoot for the moon but only hit a tree. So again, it's really imperative to make sure that you're working with the money that you know that you have, or you're absolutely positive that you will have it no matter what can possibly happen. Usually those funds are involved in a trust or some type of situation where you know that you have a date coming in the future where those funds will be available.
Our next question is from Himar. Why shouldn't I just get a Roth?
Well, Himar, there's absolutely no reason not to consider a Roth, as they do have similar tax benefits as this strategy does. However, they do come with a downside, and typically your money is at risk in the market. So having principal at risk is a mistake that millions of Americans make with their retirement nest eggs, and we've seen that over the last couple of decades. So with the strategy that we teach at Clear Diamond Life, we eliminate the risk of market volatility and we participate only in those market gains. Also, government-sponsored Roths have got small contribution limits compared to almost limitless maximum funded tax advantage life insurance contracts where the contribution is virtually without limits depending on your maximum maturability that we talked about earlier. Now, the other downside to a Roth is that you don't have the death benefit associated with your money that will transfer to your heirs tax-free and affect future generations. But we always want people to look at the Roth, and as long as the fees are not outrageous, it's not a bad plan for somebody that's not able to maximum fund an index universal life insurance contract.
Our next question is again more of a statement from Rita. My financial planner says that my tax bracket will be lower at retirement.
Well, Rita, that may be true for the bottom 75% of wage earners, but oftentimes we see a complete opposite situation in the top 25% of wage earners. And many people do believe that their tax rates will be lower in retirement. And they may, in fact, be correct. But what if they're not? Most people want to maintain that same lifestyle that they currently enjoy, and in fact, sometimes they increase it since they're now free to travel and enjoy life. And also now most people no longer have the tax deductions that they had during their working years that we covered in our earlier segment, such as the mortgage interest, child credits, and government-sponsored retirement plans. So we actually have many clients that end up in a higher tax bracket because of this, as well as minimum mandatory distributions. Now conversely, if your income is lower, you could still have a significant tax obligation due to the loss of those deductions. But again, we're more than happy to provide you with your customized wealth report based on your unique situation. So once you've completed and returned your forms, we'll schedule that call, we'll determine what your situation looks like and what the best strategies will be for you going forward.
Our next question comes from Aaron. How does leverage work? You mentioned this earlier.
Aaron, I'm glad you circled back to that because leverage is really one of the benefits that we sometimes don't have a lot of time to go in depth into. But as I mentioned earlier, when you complete your confidential client profile, you're going to receive an email with a link to create an account where you can watch our library of 14 educational videos that recap and go into more depth on these strategies that we've discussed over the last hour and a half or so. However, in video number 4 titled The Wealth Builder, I have my team go into great detail regarding this powerful benefit this strategy has to offer. This concept doesn't exist in any other financial vehicle, and again, it must be structured properly in order to take advantage of it, but here's the premise. So if you'll remember, earlier we talked about maximum funding our policy, or essentially getting as much cash into the policy as fast as we can to still maintain its tax advantages, and again, typically that takes 4 to 5 years for most people. Now, once that cash is in the policy, imagine being able to withdraw the majority of it to use for any purpose you can imagine, such as buying a car, the down payment for a house, funding a college education, or basically just about anything you want to use it for, as long as it's a wise use for that money. Now, here's the best part. The original basis will continue to accrue interest. So you heard that correctly. The total amount that you originally put into your policy will enjoy uninterrupted compounding of interest at that same original amount. Now there is a slight catch, but it's one that should be expected. You cannot realize these gains until the amount that you have borrowed is paid back at some point in the future. Now, there's no set payback schedule, so you can pay yourself back as it makes sense for your particular situation. So again, this is a complex strategy, and it's one that we can go over in our discovery session once we schedule our appointment with you.
Next, we have a question from Dahija. If this is something that my wife and I want to do, and it looks like we do, will we be working with you or with one of your assistants?
Dahija, hey, that's another great question. While one of my wealth architects will assimilate your 22-page wealth report from the information that you complete in your wealth assessment, you will always be working directly with me while we discuss your unique strategy and implement a plan for you. So really, the only time you would possibly work with one of our wealth architects is if I'm outside the office or tied up with a client. However, rest assured that any member of my team is fully capable of answering basic questions on my behalf, but we have built Clear Diamond Life by being fully accessible at all times. So yes, you would be working directly with me most of the time. And Jeff, I know you have a lot of questions that remain, but let's just take a couple more because I know we're getting close to the top of the hour, and I really want to cut this off at exactly 1 hour for the Q&A.
The next question is from Pat. When I eventually die, what happens to trigger the next event?
Wow, there's a question that doesn't come up too often, Pat, but it's another great one. At Clear Diamond Life, we take a very unique approach to every aspect of wealth planning, and we're the only company that I'm aware of that has created what we call your EAS, which stands for Emergency Alert System. The system is just that in case of an emergency. In this case, you're passing. Someone on your EAS would call us to advise us of your passing. We in turn would then notify the carrier immediately, and they would get in touch with your beneficiaries to process the final transfer phase of your policy. The EAS is generated during the application phase, and it works like this. We ask you to list 5 people besides a spouse that would know of your passing immediately. We then call them to introduce ourselves as your representative of your life insurance policy. We then ask them to take down our information and to notify us immediately in the event of your passing. And in addition, we send them a letter explaining that same information that we have just discussed with them, as well as our contact information and the contact information of the insurance carrier. This is a very important step, and it's one that most other companies completely overlook. In fact, if you've ever seen the unclaimed money fund from your state, a lot of that money that sits in those funds, it's because insurance companies cannot find the beneficiaries when it's time to invoke that phase of your policy. So we take that very serious, and it is one step that we do not overlook.
We have another question from Javon. Why should I trust you with my money?
Well, Siobhan, the good news is that you don't have to. You should never send money to anyone at Clear Diamond Life. Should you decide to implement one of the strategies we designed for you, any monetary exchange occurs exclusively between you and the insurance company. So even though we are your licensed representative, you will never see an invoice from Clear Diamond Life, nor will you ever send $1 to us. Again, every dollar that you put into one of our plans has the full backing and guarantees of the insurance companies.
Next, we have another statement question coming from Juan. He said, life insurance is too expensive.
Well, Juan, it certainly can be expensive because traditional insurance planning has you purchasing the most amount of insurance that you can qualify for. So that myth, again, that most life insurance is expensive and it's associated with high fees can be true. Now, you may also be looking at insurance as a purchase rather than a vehicle where your money can grow tax deferred. You can access the gains tax-free and your accounts transfer tax-free. And as we stated, a properly structured indexed universal life insurance policy will be less expensive over the long run, even when compared to traditional investments, as we are purchasing that minimum amount of death benefit, again, that the IRS will allow us to purchase. So again, we are not in this strategy for the insurance, but it is the required mechanism to be able to take advantage of the benefits we have discovered.
And the next question is the last one that we're going to have time for today. It comes from Casey. Why doesn't my financial planner do this if it is so good?
Well, Casey, that's a great question to end this segment on, and I think we already covered that, but just to add another thought, these strategies typically don't happen overnight. Even though we do have express underwriting available for the healthiest of individuals, many of these plans may take 3, 4, sometimes even up to 6 months to get through the underwriting process. So therefore, it's not the quick sale that most money managers focus on in their day-to-day activity. And as we covered earlier, our 7-step process is unique to the industry, as we may need to meet with you 6, 7, or as many times as necessary for you to fully understand all the moving pieces of this strategy. So by the time your policy is ready to be funded, you will know more about taxes, tax-deferred wealth accumulation, and tax-free income than most financial advisors in the whole country understand. At Clear Diamond Life, this is the only thing that we focus on, and this is what we're experts at. I want to thank everybody for the time you've spent with us over the last 2 hours. I hope it's been informative, and I sincerely hope you take the time to fill out your forms and to request an appointment to meet with us, because I know for a fact that we can seriously make a significant impact in your lives today, tomorrow, for the future, and for generations to come. Thank you again, and I look forward to talking to you very soon.